I mean, so you reduce it, just to kind of bring it together. I know we have a lot more, but just to kind of recap. So you'll have $100,000 income,
Yep.
and then you buy a truck for $50,000, and then you write off all your utilities, and then you write off your miles, and then you write off. So you keep writing stuff off.
Everybody, to Generation Boost! Today we are going to be talking about the funnest topic in the world, taxes! We are not CPAs or accountants.
Disclaimer.
Disclosure, we are not professional tax accountants.
So take everything we say with a grain of salt.
You did go to tax school though, right, Dylan?
I did go to tax school.
You are an accountant, right, Carlos?
I did do taxes for a lot of people and businesses, but no, don't take our stuff, because that stuff does change on an annual to like administration basis. Like it changes very frequently. So like staying on top of it and having a good accountant. So like the stuff that we're gonna discuss today is really just like
it's been around for years. Yeah, I was gonna say it's been around for years and years.
But it is gonna change. It has changed through different administrations. So
yes.
Yeah.
All right.
Who wants to start it?
Yeah, we're gonna talk about write-offs, stuff you can write off in your business. We're going to talk about depreciation. We're going to talk about a bunch of other things. Everything, all the strategies we use in our business. And we're going to tell you. So first off, we're going to play this little game where everyone's going to go around and talk about stuff they write off. And it might surprise you with some of the things that that we say that you might not think about in your business that you can write off.
For real estate, a real estate business.
Real estate specifics. Okay, so first off, I'll go first, and it's probably the easiest one is your interest, taxes, and insurance on any rental properties you have. So anything you're paying on interest, taxes, or insurance, you could write it off against the income you get for that specific property. All right, who wants to go next?
I'll go next. So section 179, you can write off your entire vehicle purchase price if it's over 6,000 pounds and qualifies in your state. So basically, you buy a $50,000 car, guess what? You get to write off $50,000.
Okay.
Carlos, what you got, Carlos?
All right, so I'll add to two pieces just for more clarification. So the tax, interest, and insurance that you mentioned, that's true in its entirety for rentals.
Yeah.
For your personal property, you can do that as well based on the size of your office space that you use for your business.
Yeah.
Okay.
So if your office space takes up 25% of the square feet of your house, then you can write off 25% of that. Okay. I mean, you are going to take advantage of it on your personal side too, but like you can use it as a business expense.
Yep.
Nice.
And then for yours, you can also depreciate it over time. You can take it in full, which I think most people do in our industry, but you can certainly depreciate it over time too. So whichever one works to your benefit.
My accountant just asked me that. He was like, "Do you want to do the depreciation?" I was like, "No.
Yeah.
The whole thing."
Oh, and also one other thing, and when we're talking about write-offs, it's deducted from the amount of income you make. So if you're making $50,000 and Daryl's saying he buys if on your tax return after all the other expenses, you're making $50,000. Daryl goes and buys a truck with the section 179, and it's worth $40,000. He pays $40,000 for it. Now you're only paying taxes on $10,000 in income.
Yeah.
That is my income after all the expenses.
Yeah. And you did that. I did that last year.
And to be clear, it doesn't matter when you buy that vehicle. It can be December 27th, 28th, and it still counts for the whole entire write-off.
I think we bought ours on the 26th.
Yeah. So we got ours in end of November.
Yeah. All right. So for me, I'm going to mention depreciation.
Okay, good.
Nice.
So depreciation is, I'm going to get into some detail about it, but basically you buy a property, the way that the government looks at it is there's land and then there's a building. There's something that's on it, and the government ends up splitting that up. So say the building is a small house and they say it's assessed at like $75,000 and the land is $100,000 because it's in a nice spot, then they're going to split that up and only allow you to depreciate the $70,000 building. They're not going to allow you to depreciate the land at all.
So who determines the value of that building? Is it just whatever it says on the tax records?
Is it the tax assessment?
I think no.
Or is it a percentage of your total all-in cost?
No, it's not, it's based on your basis. It's based on your cost basis.
Okay, so let's say you're all in for $100,000 on a property that's
Appraised at
that.
200.
Yeah, let's say it's appraised at 200. How do you figure out how much of that 100,000 is
Oh, for
basis
your
towards
land? Yes. So for the land purposes, it is based on the government.
Okay,
Okay.
and what the
they
tax
say-
records say.
and what the tax records say. Yeah,
Okay.
because in my day, when I would try to separate the two, that's exactly what our what the rules would be. Is
Okay.
to go to that county, wherever that county was,
Yeah.
go to that county site, figure out what the split was,
The percentage,
and
right?
separate it.
So let's say it's assessed at 200 on your tax rate, or on your, let's say it's assessed at 100, or 200, and your all-in basis on the property is 100, right? But
It goes off the county assessment.
It goes
right?
off the county assessment, but let's say the land on the county assessment is 50,000.
And the-
Does that mean you take 25% of your 100,000 basis? Does that make sense? Because 50,000 divided by 200.
No, it's never a percentage.
Oh, okay.
It's
Oh,
it's
okay.
the flat amount of what the land is recognized.
Okay.
Okay,
as.
gotcha.
Yeah.
Okay.
So
That's cool.
so whatever that amount is, I mean, if for whatever reason there's a bunch of developments and the tax assessment for your piece of land goes up, obviously once you buy the property,
Yeah.
it's set, right? Like once you buy it, there's closing docs, the closing happens. That's when the assessment is
Okay.
valued.
Okay, gotcha.
But going forward, it never changes. Even if you bought in our area, for example, like Short Pump, you bought a long time ago, 15 years ago. The value of land was less, and now it's all of a sudden $1 million for an acre.
Yeah.
Well, you bought when it was only $150,000.
So it doesn't change.
It
Okay.
doesn't change.
Okay.
Gotcha.
It doesn't change because think of it as this: it's like a snapshot of the day that the transaction happened, right?
That's cool.
And it's the value of the land and the value of your asset of the property, right?
Okay.
It's the same thing with like depreciation, and that's why I wanted to bring it
So
up.
today, you get your property tax assessment. Doesn't matter. They base it,
It
off of
doesn't
when
matter.
you bought it.
It's when I
Okay.
bought it 10
Oh,
years
really?
ago.
That's
Because what they do is, I'll give you a really simple example. Say for example, I bought a house full retail as a rental for $375,000.
Yep.
Let's say for example, the land that it's on is $100,000.
Yep.
The value of the building of the structure is $275,000. From that moment forward, I get zero depreciation on the land, and I get 27 and a half years of depreciation on that building.
275.
275.
Okay.
So now I can depreciate it.
10 grand a
10
year.
grand a
10
year.
grand a year.
Yeah.
Exactly. So now I can depreciate it 10 grand a year until it runs out.
That's
Again, it doesn't matter that if in the year 25
you still get a 10 grand.
that building is worth $1.5 million and the land is worth $1 million. It doesn't matter.
Okay.
It stays as a snapshot the day that you buy it.
Now, what if you refinance? Does that change any of it?
No, I don't think that it does.
Okay. So
Because I think that all it does is it changes just the terms of your loan. You still own it.
Yeah.
It's not like you've transferred ownership.
So for us, that kind of stinks because we're buying them at a 50% discount, and now we're getting the
Yeah.
tax credit at a 50% discount. That kind of. But hey, I mean.
But it is what you
Some-
put into it, so it's not
Correct.
like you're
Yeah.
still getting a deal because you have it at 50% of
Because
what
you
it's worth.
exactly.
Yeah.
Okay.
Yeah.
That's cool.
Sorry, went down a rabbit hole. So,
Yeah, I was just asking for myself because I was curious.
Same, yeah.
So that's,
I figured I'd ask an accountant.
so that's depreciation.
All right, and how long can you depreciate a commercial property? How many years?
39 and a half, right?
I think it's 30,
39.
not 39.
Yeah, I think it is 39.
Don't quote us on that.
Yeah.
Yeah. Pretty sure it's 39.
Google
39
it.
and a half. Google it.
So another one I wanted to bring up is repairs and maintenance on rental properties, but also I wanted to bring up capital expenditures as well because
Yeah.
there's two different
Yeah.
columns in that.
Nice.
So repairs and maintenance, at least for me, is a little toilet needs to be replaced or little leaky faucet that needs to be replaced. You
Yeah.
write that off in that same year, write the whole thing off. Now you're supposed to, if an HVAC goes out or if a roof goes leaking, you have to replace the whole roof, the whole HVAC. You're supposed to add that to you're supposed to depreciate that over a longer period, and they have different schedules for
Yes.
each
Yeah.
different thing. What I usually do is I just add it to the basis of the house sometimes. Like it's a $6,000 roof replacement. I'll just add that to the basis of the house, depreciate over what Carlos was saying, 27 and a half years.
Yeah.
Nice.
Obviously, there's probably more tax-favored ways to do it. I guess I don't keep good enough books to keep track of. I'm
Each
taking off,
individual thing.
1,000 a year. And then for the repairs, anytime a tenant calls, anytime anything happens, you send a contractor out there. Lawn maintenance, they go out there. You can write that off against your income, and boom, you're paying less in taxes.
Nice.
And anything to add on to that?
Yeah. So there's expenses and there's capital expenditures.
Yeah.
Right. So like that's kind of what you were bringing up about like replacing a roof, replacing an HVAC, those type of things. You can depreciate if you decide to, or you could take it as a lump sum
Or you could
How?
write it off of your income, right, on the property.
On the same year?
as an expense.
I don't think
Yeah.
you're supposed to though.
Say you're making $1,000 a month, 12 grand a year, and you get a bad roof, cost you $6,000. Really, you only made $6,000 this year.
Yeah, you're not supposed to. You're supposed
Okay.
to do it over a certain amount.
Over a certain
Yeah.
amount.
Yeah, because
Okay.
it's not a repair. It's
Gotcha.
it's
Yeah.
a bigger
It's
ticket
a,
item.
It's a capital improvement.
Well,
It's
that's
an
why we're
impro-
doing
it's a-
this, so we can
Yeah.
more
It's
details.
an improvement to keep the sustainability of the asset
Gotcha.
type of thing. Whether it's like major electrical, major plumbing, roofing,
Yeah.
HVAC. So like integral parts of like the structure as a whole would be
Nice.
like a capital improvement. Driveways, stuff like that like help the accessibility of is a capital expenditure. Otherwise, pretty much everything else. I mean, you can to your point, you can write off lawn care. You can write off
Oh, yeah.
pest maintenance.
Yeah.
You can write off. I mean, you're not going to do it just to have an expense because there's other ways of writing it off.
Of course.
But yeah.
But those
you
are
can-
normal things that you
Yeah.
get done to your houses anyways. I mean, I
Right.
get my
Yeah.
grass cut at most of my rentals, and I
Yeah.
charge them for that.
Yep. Cool.
Yeah.
What you
Cool.
got next?
So next, I got conferences and education.
Ooh, I
So-
didn't even have that one.
Yeah,
Yeah,
that's
so
good. I didn't
that's
think
a
about
huge one.
that.
Invest in yourself, and
Yeah.
it's a write-off.
Yeah.
So basically, we all go to how many conferences? Mini conferences
Yeah,
a year.
yeah.
We take classes.
Yeah.
Y'all are in Ring Elite, which
Yeah.
you pay per month, every month. You
Yeah.
get to write that off.
Yeah.
So why not write off something that benefits you in education?
And also plane tickets and hotel stays on the way to that conference. I believe you can write off the whole thing.
You can. You
Yeah.
can write off the whole entire thing.
Yeah, as
so you
long
go
as
stay in a
it's like
hotel.
day.
Say
Yeah.
our conference when y'all went to New Orleans for the
Yeah.
bigger pockets. You get to write off your
Yeah.
airline tickets and your hotel.
Yeah.
So I would recommend a lot of people do that because your biggest value and your biggest asset is you.
Yeah. Now, how soon can you start writing that off?
What do you mean
It's
by
almost like a
that?
trick question. So,
Yeah.
so say you're
Oh.
an investor.
Yep.
You want to be. You're an aspirational investor, but you haven't quite done a deal. You're not making money, but you all of a sudden have spent. I mean, we've heard of stories. of people-
Thousands.
yeah, tens of thousands of dollars. But like, say on a nominal scale of like $7,000 in education, can you write that off, or is it just a hobby that you want to get it? Like, I don't know. Like,
So I think there's like a gray area there because how do you define it just being a hobby versus? Because there's a lot of overanalyzers out there. What is it, analysis paralysis?
Yeah.
I mean, I can't tell you how many investors I've met that have that, and they go to all these classes that we go to, but have never done a deal.
Yeah.
Not that they don't want to do a deal, they just overanalyze it, and in today's market, it's gone before they ever got done analyzed.
especially nowadays.
Yeah.
Yeah, no, but that's
So-
a good one. Education, anything
Yes.
education related to the field that you're doing, and that's not just real estate, but that's
It's
in
not
that's
any field.
yeah,
Yep.
that's any field.
What you got, Carlos?
All right, so
Oh, Carlos is the loser?
no, 1031.
Okay, 1031. Nice. Please elaborate.
So section 1031 is a section in the tax code that allows you to defer capital gains for a later date, right? So it's you buying a property, making improvements, keeping it for a while. I think there are some, not limits, but there's some rules that you have to follow for how long you have to have it for. I think it's over a
1 year.
Yeah, one
Yeah,
year.
so you keep it for over a year, and basically you keep it as a rental, right? As a business operation, and then you unload that property. You decide to sell that property. During the process of you selling it, you do have to disclose that you're looking to do a 1031 exchange. So that does have to be outlined so that the buyer knows that the process of the closing might be slightly different and might take slightly longer for it to happen because you're looking to do that exchange.
Yeah.
And then
Right.
how long do you have to identify the next
Ooh,
property?
I always forget.
So it's 45 days to identify,
Yep.
and then
Is it
100,
45 days?
yeah, and then 180 to close.
Oh, okay.
180
Yeah.
to close.
I
Yeah.
thought it was
Yeah.
180 to identify.
Did you know those numbers?
Yeah, and now the good thing about the 1031 is you get to roll all of your profits. Now that's the tricky part is all of your profits have to roll to your next deal.
All of them.
All of them.
I mean,
not
Dylan-
1,000, not 2,000.
Yeah.
You don't get anything.
Dylan can probably
You
tell
can't
you-
even touch the money either. It has to stay in a
Stay in
separate
escrow.
escrow.
Yep.
Yeah. Which the bank, the title company controls.
Yeah, or the attorney.
Yeah.
Usually, it's,
Attorney.
I think it's
There-
like a
there's
third party.
specific-
or
Third
something.
party usually.
Yeah.
I mean, you could probably elaborate a little bit more on it because I've never done or considered a 1031, but you looked into it a little.
Yeah, so I was selling a property in Petersburg, and I was making about an $80,000 gain on this property, and I was looking at the 1031 and if I should do it or if I shouldn't do it. If I did do it, the reason I decided not to is because I would have to take that full 80,000 and put it as a down payment on another property. So I would.
Yeah.
The reason why I didn't want to do it is because first off, it'd have to be a huge property that I buy if I'm putting 80,000 down.
Yeah.
I'd only want to put 20% down on the property.
Yeah. Could you refi that out at a later date?
Yeah, so I think you can.
I think it has
I
to be a
don't know.
certain amount of time.
It
though.
might be a
I
certain
believe,
amount of
yeah.
time. If that's the case where I could refi it right back out, I wouldn't mind doing that. But for me, I'd rather use that like part pieces of that 80,000, 20,000 here for this property,
But now you're
20,000
getting
here
hit
for this
with
property.
60%.
But also, it's
Long-term
long-term
gains.
gains, and right now I think long-term gains are probably the lowest they'll ever be anyway,
Yeah,
at
yeah.
20%. Or
They are.
Yeah.
Yeah.
it will. With the tax bracket after all these write-offs we're talking about, I'm probably paying like 15.
You're in the negative tax bracket. Yeah.
So that's
They don't
also.
give money.
So he gets some of our tax return money.
So
Check.
that's also something to consider too. Since I don't think I'm making that much this year because I'm not selling that many properties on short-term capital gains,
Yes.
I decided I'll just take that gain.
Now, someone like me and you, Carlos, we're going to have to consider 1031 because
Yeah.
we do enough flips to where we don't want much more income.
Yeah. Like some of my assets, in my portfolio. I mean, the gains are either fully paid off or there's close to $200,000 worth of equity. So like in those situations, I'm not looking to get hit.
Same.
You know what? $60,000.
Yeah.
I mean, that's a hard hit.
And
So
but now the downside is when you do a 1031, now you have to find a property that's worth more than
Yeah.
$200,000. That's
sure,
hard.
yeah, but
It also doesn't have to be though. If it's not, you just take a percentage of whatever is less.
Oh, okay.
Yeah.
Gotcha.
Isn't that
what do
right?
you mean?
I
So
thought
you
you
don't
had to
have to
roll it
find
all
a
in.
greater, more expensive property. You just have to pay taxes on what you don't use out of that gain. That's what I thought, but maybe I'm wrong. So if I'm selling a property
I
for
don't know.
200, but I'm buying a $150,000 property, I have to pay taxes on 25% of my gain.
Yeah.
But maybe I'm wrong though.
From remembering like reading it, it was like or greater.
See, that's
With
what
the
I thought.
verbiage.
Like
To get
or
it,
greater.
but to get it completely wiped or completely
Sure.
deferred.
To
Yeah.
pay completely deferred. It
Yeah,
has to
but
be
I guess
like or
we'll have
greater.
to. Hey, in the comments, if you know the answer, put it in the comments down below.
Yeah.
See who's right.
Yeah, I think it's like or greater, but I don't know. Like, but that's kind of a strategy for me because I do want to get to a bigger asset class.
Yeah.
So like in a way, like I'm kind of keeping that as like an account aside, so I can then cash out, sell
$1
it,
million
1031 it.
apartment complex.
Exactly,
now
and
you're
then I have
$200,000.
$200,000 for $1 million building,
Yes.
right? So like
Now you're 20%, just like Dylan was saying. You don't want to put much more than that, so
Yeah.
now there is your 20%.
exactly. So I'd rather do that kind of rollover
Mhm.
than like have the cash and then like be emptied out. I mean,
That's cool.
can I get cash somewhere else to add to my 200? Sure.
Of course.
You can always
Yeah.
combine. But the one other tricky part is that you can't like commingle funds from or to a 1031, right? So if you have a property in your tax entity,
Mhm.
the money has to be transferred to another an asset that's going to be owned solely by that.
So you can't partnership. No, you
Oh,
partnership.
okay.
Oh, really?
That's, I
So
didn't
you
know
have,
that part.
You have to have it in full. In
So
that
these
tax
people
application.
1031ing apartment buildings, they own those out that are keep moving up. They own those outright.
For them, I think that they're doing something where I don't know how they're doing it, but I think that there's some sort of like trick that they're doing.
But it
that I
could just
haven't
be
been
that
exposed to.
LLC, and now they're changing their operating agreement to include
It could.
the 50-50 split.
Or when they bought their first few, they were together already, and they just keep moving
Correct.
up together.
That could be the case
Yeah,
too.
but I do know that that's something that kind of handcuffs a lot.
So if you buy it in XYZ LLC, your next property needs to be bought by XYZ
yeah, we
LLC.
couldn't all bring together 1031s and then buy something bigger.
Gotcha.
Yeah.
I didn't know that.
Yeah.
Interesting.
What you got, Dylan?
All right.
And then the other thing I'll add to the 1031. So I mentioned deferring it, right?
Yeah.
We all want to defer it for as long as possible, but you essentially defer it indefinitely until
You die.
you sell it,
You sell it or
you pass, and then when you pass,
on stepped up basis.
yeah.
At that point.
So
yeah.
you buy a $1 million building.
The Unless that
richer,
changes.
baby.
Yeah.
I mean, that could easily change in the next couple of years.
It could.
Biden administration talked about the change in that stepped up basis.
Yeah.
So the reason I don't think that would happen is because there's a lot of money behind.
That's true.
That.
Oh, there is a lot.
I mean,
they can talk about it, but let's be real.
Yeah.
The people that are behind it are very powerful.
yeah. Imagine how much money would get lost.
Oh,
Yeah.
yeah.
Just by that.
Right.
I mean,
so many lawyers,
I would
judges. Why would they do that?
What? I would pay up to close to 10% of my net worth because I know that I could lose it all.
Yes.
And you would probably do the same, and so would everybody else, and we could
Like that.
manipulate things.
Yeah.
Yeah.
We could persuade people
Yes.
in a certain direction just to avoid.
And imagine the people that are 10 times more powerful than we
Exactly.
are behind not doing that.
Exactly.
Yeah, we could probably have our own whole video about 1031.
Yeah.
But,
Yeah, seriously. Yeah. What you got, Dylan?
mileage. So, is that what you're going to use?
No, that's a good one though.
So, every time you drive your car, keep a mileage log. If you're using it for business, you can write off 65 cents
It keeps
per mile?
changing. I don't
Yeah,
know.
it changes every year.
Yeah, every year.
Between 56 and 65 cents probably.
Yeah. Do you
can
use an
write off.
app to control your
Yeah, Mile
mileage?
IQ.
Same. That's the best.
Except it sucks because it was like locations off only when using apps. So like the last 8 months I wasn't recording my mileage. I was like, dang, I'm paying $60 for this app. I forgot to turn on the location.
Now, so you do mileage.
Yeah, and you could either choose one or the other, right?
Yeah,
One or the other, mileage or gas receipts.
expenses.
Yeah.
So what do you got?
It's like maintenance and gas.
Yeah.
So you can do that, or you can do mileage.
So with you, since you're always going to the dealership of your truck and fixing stuff, you'll probably choose maintenance.
Well,
do you guys know what you took on this last tax return?
yeah. So for me, it was gas.
It was gas.
Yeah, it was
See,
gas
I took mileage.
Gas,
You did.
gas and
Yeah.
maintenance.
I forget what I took.
See, I might switch it this year's to gas and maintenance.
My,
I keep log of all of my gas receipts too, and my mileage.
Yeah.
I spent a lot. I spent
A lot.
It was
Yeah.
like $7,000
Yeah.
just in gas last year.
And I think it should be different because mileage for your car, little Toyota, is way different than my truck.
Yeah.
I mean,
Yeah.
so why would we get taxed the same on mileage?
Yeah. Well, I guess that's why you get to choose between the gas and the.
Because
Yeah.
my gas probably adds up way more than
Yeah.
your mileage.
Yeah, and then I'm paying for brakes. I'm paying for tires. I'm paying for a bunch of stuff that
Yeah.
it's
Wear
very
and
different
tear.
on your car than it would be, say, for my car.
Right.
Yeah.
So,
Yeah,
so
the
yeah,
tires
you do
on
get
your
choice.
car is $600 versus
Yeah.
the tires on ours. I don't know about you, but I'm getting new ones right now, and it's $1,400
Yeah,
for
Wow.
basic tires.
yeah. No, it adds up. It adds
Yeah.
up for sure.
All right, D.
Nice. So materials for future projects. So
Ooh,
last year,
that's a good one.
Yeah.
That's a good one.
So last year I had 4 projects in the works. And everybody was talking about how everything was going up at the beginning of 2022.
Yeah.
So I went out and bought appliances for all 4 of them. I bought all of this stuff to
Did
make
you
sure.
use all that?
Oh, I've used all of them.
You've already used all the
Yeah, I
appliances?
used all the appliances. I bought
It was worth
lights,
it. It was worth it.
vanities.
Yeah.
I
Yeah.
bought faucets. I got a whole stack of them in my garage just because I got a good deal and I
Yeah.
was afraid it was going to go up.
All right. So just for clarity, you bought a bunch of materials that you were going to be using
Yes.
for the following year, but because you spent it, you bought
Purchased it
in
in that.
2021.
I got the
so
write-off.
the year before, you got the write-off in full.
Yep.
As if you
supplies.
had used it on the project.
Correct. Yep. Just
And that's not like a cheat code. Like you're not like doing something funny. That's an actual
That's
thing.
a real thing. You can have supplies for your future projects and things like that.
Yeah, that's a good one.
Yeah.
Yeah, I didn't think about that.
Yeah.
What you got, Carlos?
I'm gonna say I'm running out of stuff.
I still got a few more, man.
All right, so I'm gonna say personal expenses, for example, or personal like utilities. For example,
Ooh,
on rentals.
No,
on
your personal house. That's a good one.
Oh, if you're using it as an office, you're talking about.
Yeah, if you're using it as an office.
Yeah.
You got internet, phone.
Yeah.
Well, that's only if you have a home office. If you don't have a home office, you can't do that.
And now some of these things are LLC related. Like you have to
Yeah.
have an LLC in order to write off a room in your house.
Yeah.
You have to have an LLC to write off your phone bill.
I don't know if you need to have an LLC to write a room.
So I believe you do, unless you're considered working from home. I think.
Oh, okay.
I don't know. I think there's rules to that.
But yeah, so I'm able to write off my car insurance
Yes.
because I'm usually in my car working, right? So car insurance, car payment. Well, I guess car in full.
Full, yeah.
Cell phone, Wi-Fi,
Yeah.
Utilities
Yes.
for my house. I mean, just a
Your
lot
office.
of like, yeah, for my office. So just a lot of like the things that you need on a day-to-day basis. I'm writing them off either in full or in large part.
And that's the benefit of what we do because
Yeah.
I mean, how many friends do y'all know that pay the same bills we have, except for they don't get to write it off in their income? My buddy's a UPS driver and he doesn't get any write-offs.
It's an expense.
It's an expense
it's
every
straight up
time. So he
expense.
makes his $100,000 a year, and then he pays his cable bill, his phone bill, everything that I pay, except for that gets taken off of my 100.
Yeah.
So,
Yeah.
that's cool.
Exactly.
Yeah.
Yeah. So I mean, so you reduce it, just to kind of bring it together. I know we have a lot more, but just to kind of recap. So you'll have $100,000 income,
Yep.
and then you buy a truck for $50,000, and then you write off all your utilities, and then you write off your miles, and then you write off. So you keep writing stuff off,
Yeah.
and then basically at the end, if you're only left with a $30,000 income, even though you're probably at like $80,000 because you didn't pay
You didn't pay
$50,000
50 for that
in
truck,
cash, right?
Correct.
So even though it looks like you're at 30,
Yeah.
you're really at 80,
But you're taxed
and you only
on
get taxed
30.
it. Isn't that a little unfair though?
Oh, it's beautiful. I mean,
Okay,
it's
but we're
awesome.
good. We're good. We're supplying housing for all these people.
Correct.
You know?
Yeah. I mean,
Fix
you
up
could be on
houses.
either side of the spectrum. You can either
Yeah.
look at it as crazy, or you
Yeah.
can hop on board
Yeah.
and jump into a business and start. I mean, we all took the risk.
If you
to
can't
get
beat
here.
them, join them.
Like, let's be. I mean, let's be real. We take a risk every day. No one comes home and says, "Hey, how much money did you make this week?"
Yeah.
I didn't get a paycheck. I
Yeah.
don't know about
Yeah,
y'all,
yeah,
but I didn't
yeah,
get a
yeah,
paycheck
yeah.
this week. You guys went to work for 40
Yeah.
hours and made $800 or whatnot.
Yeah,
You got
yeah,
a
yeah,
paycheck
yeah.
on every Friday or every other Friday.
Yeah.
I get paid once a month with my rentals.
That's fair.
They pay their rent, and then I'm lucky if they're on time. Usually it's not until the
Yeah.
5th or the 8th when I get paid.
Yeah, you always run that risk on a month-to-month basis.
Yeah, month-to-month basis.
Yeah, and it seems like all congressmen own real estate, so those probably won't change. These write-offs probably won't change anytime.
Oh, they won't
So,
change,
yeah.
yeah. What you got?
Gifts and donations. So
Ooh.
anytime you buy someone a gift or you donate towards a charity, you can always write that off.
Nice. Do you give your realtors gifts for bringing you deals?
I
and
give
stuff?
my lender. He loves bourbon, so I go to ABC, get him
Nice.
$100 bourbon sometimes if he lends to me.
I do that for my
Yeah.
closing agent.
Yeah.
She's a big drink. Oh yeah, she drinks all the time. Dude, I'll show up in there with a bottle of Jim Beam and she goes crazy. She's like, "You want to close when? You want to? Oh, I'll do it for you. I'll follow all your stuff."
Let's show up on Sunday.
It's awesome.
Alright, so
Nice.
Oh, unless you have something
no,
after that.
no,
Okay.
I think that's good.
So I got the Augusta rule, section 280A. Y'all probably don't even know what this is.
What is
I've
this?
heard of
What is
that.
this, Daryl?
It allows homeowners to rent their home for up
for
to
themselves-
14
to
days
themselves or their business.
per year
Yeah.
without reporting on your personal income tax.
Have you done that?
I have, yes.
That's
actually.
new,
No
right?
way.
That's
Yeah.
new, right?
It's not that new. I think it's been out for 4 or 5 years now.
Oh, okay.
Yeah, to where you can actually rent your house to your business for
Yeah.
14 days in a year as a off a meeting or so forth, and you just hold a little meeting, like kind of like what we're doing at your house right now.
Yeah.
All these videos that we're recording, you could write these as us renting it here at Augusta 288.
Wait, so you're paying yourself from your company, right?
Correct. So this house right now is a $200 a night stay.
Well, how do you determine that number, the $200? It's just kind of
that's really up to you. You
Okay.
can you can pick whichever
It has to be
value.
reasonable.
Now it has to be reasonable.
Right.
You can't, if the Airbnbs and the hotels are charging $200 a night, you can't be charging $400 a
Yeah,
night.
yeah.
But you got 14 days an entire year to write off
Yeah.
on your house.
But then you get taxed on that.
No, you don't. So
You get
don't.
taxed on
You do not have to report it on your personal income tax.
Really?
Otherwise, it'd be a net.
Correct.
Yeah, yeah.
You
You have to like.
do
Then
not.
they're just getting it somewhere else.
Yeah, you do not have to report on your personal income tax, your individual income tax. Pretty interesting, right?
$300 a night.
Yeah. So I would say that this is easily a $4,000 or $5,000 write-off for you for us recording here,
Yeah.
and that's 100% legal.
Yeah, I had heard it.
Yeah.
I've heard that on TikTok before.
Yeah.
Follow us on our TikTok.
Follow us on TikTok.
All right.
Yeah.
Are
so
you
what
out?
I'll
go through the rest of mine real quick.
I'm
if
out.
you want.
Yeah.
You're out.
I'm
Yes.
Actually, me and Daryl will battle that.
Okay.
So I got phone bills. Any phone calls you're doing with your business phone, AT&T, Verizon,
You
you can
just
write
stole
that.
that from
It's
Carlos.
okay.
Did you say
That's it.
You said phone bills?
You're so
All your
smart.
bills,
Yeah. He
You're
said
so
utility.
smart.
No, he said utility.
I
All right.
said cell phone.
Utility.
All right, I'll switch
All
one.
right, all right.
Any type of marketing you do, if you're sending mail.
I said that. No.
Any type of marketing, any type of
That's a good one.
any systems you're buying,
Okay.
Yep.
you write that off.
So I would say apparel. You can write off apparel,
Yes.
so you can get your logos on all of your clothing, your sweatshirts, your everything,
Yeah.
and you can write that off because it's self-marketing.
Yeah.
You're walking around and you're in Lowe's every day. Guess what? I can't tell you how many people ask me what I do just because it says "We buy houses" on the back of my shirt.
You're really good about that.
Yeah. So it's little
And,
things like that.
I mean,
we
you're
don't
gonna buy
think about.
sweaters. You're gonna buy, and the nice thing about that is like there's so many websites out there with good brands.
Good brands, yeah. Because
Yeah.
I don't
Everybody's
like wearing your
brand
traditional
loyalty, like-
crap. I like to
Yeah.
wear a Under Armour or Nike or something like
Yeah.
that, and I just put my logos on the back.
And usually it's priced just about the same.
It's just about the same.
You're gonna buy it anyways, right?
Yeah.
Yeah.
Yep.
Why not have your logo on
So,
it?
and if it's comfortable and you like to wear it every day,
Yeah.
you're gonna
Why not?
basically self-brand yourself,
Yeah.
and now
Yeah.
you're marketing everywhere you go.
Exactly.
Yeah.
That's a good one.
What you got, Dylan? Come on.
LLC formations. Anything you put towards LLC, the $400 what is it, $400 renewal fee or
Yep.
something like that, and I'll also add in there any accountant bills
Yep.
when you have then do your tax preparing or profit and
Nice.
loss statements.
Yeah.
So I got insurance. You can write off your umbrella
we already
insurance.
said that.
So he said car insurance and those. I'm talking
Oh,
umbrella.
what do you think, Carlos? I said property taxes and
Okay.
insurance.
Okay.
But okay.
Okay.
No, we'll give it to
So
you.
your,
We'll give it to you.
umbrella policy that you have on your rentals, your construction company, all of that, that's a write-off as well.
Yeah.
Yep.
You got
Let's see if I
I just
got
been
anything
winging it.
else.
I got nothing else.
You can write off this speaker because we're using it towards business.
Speaker.
Hey, he's
Nah.
digging deep now. Dig it away.
So this table, whenever you finish it.
All right, but
Well, I got nothing else. So.
yeah, so that's all. A lot of the write-offs. There's probably a ton more that we can't think about.
Are you kidding me? There's a million
yeah.
more. I mean,
Yeah.
the tax code is what, 300 pages?
Yeah.
Yeah.
I know.
And the crazy thing is, people don't understand it, but the tax book, no one has ever read it. Like, let's be real. 99% of people have never read it. Only 3 to 10 pages are on what you can't do and all these things.
Yeah.
All the rest is telling you what to do to get
not
more
pay.
write-offs,
Yeah,
to not pay.
Yeah.
People don't understand that.
Yeah, and it's
A lot of things.
it's really fun to really start diving into the interesting things that people actually do. And I'd love to have a CPA on that's
Yeah,
specific
I know. I was
on
thinking
it.
that.
Yeah,
'Cause,
that'd be cool.
We hear about these people that go out and buy jets.
Yes.
Right?
And it's
Greg Cardone.
do you really need to buy jets?
Chris Crone.
Well,
Chris Crone,
for his business, It's
He does.
necessary,
Yeah.
Yep.
right? He is traveling nationally from state to state,
Yeah.
and sometimes on the fly in order to get to those. So, like, you might need to make improvements to your life, a necessary
A
improvement.
jet is like a car for us because
Yeah.
me and you get leads in South Chesterfield or Richmond, and we got
And
to
we gotta
drive.
30 minutes.
He gets a lead in Florida, and he flies from Virginia to Florida
Yeah.
the next night.
Exactly.
Same
Same thing goes with
Bigger
like
scale.
holding meetings, right? Like that was something else that we didn't really. I guess we kind of mentioned it, but like, so having meetings and paying for those meetings,
Yeah.
like you do have that expense.
Yeah.
So
Yeah.
can you host meetings on your deck? Can you host meetings
Yeah.
on your personal boat?
We didn't even
Your
talk
personal,
about
like-
food. Like
Yeah,
Oh,
we
meals
did.
and meals and entertainment.
Yeah.
Oh, meals and entertainment. That's right.
How did we not talk about that? Yeah.
I know we meet up often.
Often, yeah.
It's always
Every
on our
week
business
we're
card.
meeting up to
Yeah.
have our, yeah.
It's like card roulette. Just turn it this time.
Yeah.
No, but yeah, it does get it's not as boring as what it is. It's really interesting once you like
Yeah.
dive into like things that you can write off and then the improvements to your life just based on business necessities
Yeah.
that are usually required for it anyways.
And helping people. I can't tell you how many times I bring my guys lunch or dinner that's
Yeah.
working on my properties.
Yeah.
And dude, they go crazy over that. And it's
Yeah.
just a simple deed. And it was a write-off.
Yeah,
Like
yeah.
I mean, I'm not gonna say I did it for a write-off, but at the end of the day, it benefited me.
Of course.
And it didn't cost me
Yeah.
$50. It cost
Yeah.
me $50 now, but I'm gonna get it back,
Yeah.
a percentage back. at
Yeah,
least.
yeah. I mean, I've done that with. You mentioned bourbon. You mentioned
Yeah.
gifts. Like I've bought my guys tools.
Yeah.
Same.
Oh,
I've
they
done that
get
too.
I do that all the
super
time.
stoked.
So
yeah, they
nice.
get
Yeah.
super stoked. You buy them tools, they become more efficient.
Yes.
They love that you gave them that gift. It's
Yep.
a write off at the same time. I mean, there's like so many benefits to it. And the purpose of all that, in my opinion, is for you to continue to do strong, better and better,
Yeah.
better improved business, right?
Yeah.
So you make more money, so that you continue to do more business, employ more people,
Yep.
put out more houses. Like it really is just there to encourage for us
Yeah.
to do more.
The way the tax code is written and set up, it's meant for you to help more people. And
Yeah.
guess what? You get a benefit from helping them.
Exactly.
Not only did you feel good about doing it, but now you get something that benefits you on the back end.
Yeah.
Yeah.
I mean, our society's
So-
kind of set up on that, so.
Yeah. That's cool.
So reach out to your accountant. Your accountant probably won't be up front and tell you all this, so you
So that's-
kind of have to reach out. At least with mine, I have
Same.
to bring up all these. They won't be like, okay, are you writing this off? Are you writing this off? Are you
Unless you're
writing
paying
this
a
off?
lot.
Unless you're paying a lot. So
yeah.
definitely stay up to date on the things you can write off and can't write off. And then if you have any questions, then ask your accountant. But
Yeah.
it's hard to find one that will just
Openly tell you, hey,
Yeah.
did you do this year? Or hey, did you do this year? Like I had to tell my accountant
Yeah,
that we
me
bought
too.
a new vehicle this year because I told him that, but then I had to bring him a closing statement and
yeah.
everything when we purchase statement and show him everything that we bought. With it.
I think we probably get more from like the conversations that we have,
We do,
right?
yeah.
It's like, oh, did you do this? Did Augusta? Like, all of a sudden it's like, oh, fuck, yeah, I need to write this thing.
I need
off,
to,
right?
yeah, I need
Like,
to tell my accountant, and that's
Yeah.
why.
Yeah, because
I
my
wrote
accountant
this
would never
down.
bring that up.
He
Yeah.
never bring that
Yeah.
up at all.
Yeah.
It's same. My accountant never brings any of this stuff up.
Yeah.
I'm the one that brings it to him. Hey, I spent this on food and conferences. Hey, I spent this on airline
Yeah.
tickets to get to the
Yeah,
conference.
yeah,
So
yeah,
these are things he wouldn't know about unless we told him.
yeah, exactly.
All right, so don't forget to hit that subscribe button, hit that like button, comment. If you have any questions or anything that you want us to talk about, put that in the comments as well, and we'll bring it up as a topic. I know tax strategies can be boring, but they are very important. So this is Generation Hey! Oh!